trade without indicators. See why indicators like stochastics are lying to you. The idea to trade without indicators is completely mind-blowing to many traders. There is a good reason why. Most traders have been programmed to believe that you have to trade with indicators. Indicators are just formulas. They somehow feel that these random and arbitrary formulas actually provide some insight to the market. It seems kind of strange that so many people plaster these formulas on their charts as if they were a magic button that will tell them where the future price is headed. I can certainly understand why traders would prefer this. After all, it's a lot easier to just follow these indicators blindly than taking the time to learn to trade without indicators. Stochastics have been lying to you. I'll prove this theory with one of the most popular indicators around, stochastics. For those that don't know what stochastics are, they are basically an indicator that supposedly tells you when the market is oversold or overbought. The most common way of trading this is to either sell when the stochastics are overbought, usually over 80, and buy when the stochastics are oversold, usually below 20. The other common way is just trade when the two stochastics lines cross each other, i.e. sell when it crosses downward and buy when it crosses upward. Question this. Before I even get to what's wrong with this, think about one thing. What in the world does this have to do with anything? Do you think that Warren Buffett is asking his broker where the stochastics are at before he trades? Somehow I just don't think so. Anyways, here is what is wrong with trading like this. These indicators are completely, 100% lagging. You know what makes it even worse? It's the fact that you don't see it when you're backtesting. In backtests, stochastics look phenomenal. That's how they get traders hooked. They think that these indicators, like stochastics, are perfect, because in the backtests, they are. In the backtests, stochastics looks like they grab every single swing trade perfectly. From a beginner's perspective, you could see why they would fall head over heels with stochastics. It's a different story when you are trading live. Here is what you don't see when you trade live. All those stochastics crossovers on the two stochastics lines have probably happened 4 or 5 times before that final crossover. In other words, when you backtest stochastics crossovers, you only see one crossover when it catches the perfect entry to a swing move. But in real time, they might have crossed over 5 or 6 times only to revert back. In a nutshell, if you traded every single crossover, you would have had 5 or 6 consecutive losing trades. The bottom line is you have to ask yourself, what exactly is this telling me? I'm just randomly trading lines that cross each other. If trading was this simple, shouldn't everybody be successful trading?